Okay, once again, welcome to everyone. My name is Erik. I'm from Autochartist, COO at Autochartist, and I want to quickly take you through some changes that we've done in the application. And obviously the main topic for today is completed and emerging patterns. What are the differences? How can you tell the difference? And how do we use these two different types of patterns? I'm just a little bit concerned. I still haven't received any response from anyone that they can hear me. Is there anyone out there who can hear me at all? Winston, I see you're online. I'm just unmuting your microphone. Can you hear me okay? Okay, great. Thank you very much. Good, then I'll continue. So on your screen, you should see the Autochartist application. Now, some of you may have noticed that in the past week or so, things have changed a little bit. We've tried to keep things very much the same, but there are some fundamental differences that we've made to improve the use of the application. And I'm quickly just going to run through these changes with you. First of all, you'll notice that the application has become a little bit slimmer and longer, and it fits into screen size much better. So even for smaller laptops and portable devices like tablets, iPads, it's become a little bit more useful, a little bit more user-friendly. We've actually taken out the two adjacent columns where we had emerging and complete patterns together, adjacent. With this view, we think the layout is much more suitable and just in general easier to use. You'll also notice that we've got only the one grid at the bottom now, and in there what we've done is we've consolidated all the different pattern types. So there are chart patterns, there are Fibonacci patterns, and the new type of analysis that we call key levels. Key levels are nothing more than just simple horizontal support and resistance. So all of these type of results have been consolidated into this grid below, and we've added this little results filter. Now if you don't see the little results filter, click on this little link just under the view analysis button, sort of in the middle of the screen, right up against the right hand side. So this little link, the results filter link, will either expand or contract that little filter. Now this filter is to just preserve your sanity. If you can't handle all of the different pattern types like me, I choose to uncheck quite a few of them, and as I unselect them, they basically disappear from the grid as I do it. So for example, I can choose to view only completed chart patterns at any given time. I'm just going to set up my little spotlight here. You can see this little, these little icons are just for your easy reference. What do chart patterns, Fibonacci patterns, or key levels look like? And these would be identified in this little column down here, next to the pattern name, just for easy reference, so you can quickly pick up what kind of a pattern this is. Okay, the other thing that we've added was to incorporate this age column. The age column is, it basically allows one to view the latest trading opportunities in order of freshness, if I can put it that way. What we mean by age, you can see we measure age as a number of candles, and it's exactly what it means. So a pattern with age 5 candles, for example, that would simply mean that after the pattern was identified, 5 additional candles have formed. And if it's, for example, a 240-minute pattern, that means 5 additional 240-minute candles have formed. Just going to enlarge this view a little bit so you can see more clearly. Each one of these candles represents another 240 minutes or 4 hours. So we have 5 additional 4-hour bars that have formed. What this view does, what it allows you to see, is that longer term patterns like end of day patterns don't lose their precedence over short term patterns like 60-minute patterns at the beginning of every day. What used to happen is you would have a few end of day patterns in the beginning of the day, but they would very quickly be pushed down the list because we used to in the past identify or sort the list by the time when patterns were identified. So you'll see here, for example, this 60-minute pattern was identified at 9 o'clock today, much earlier in the morning, whereas my end of day pattern was identified only at the this one here was identified only at 8 o'clock at night when the markets closed, literally. Or way after the markets have closed. So in this case, it's the time when the pattern was identified is no longer a very important indicator, but rather how many candles have formed after the identification of the pattern. Remember to look at the three different things in conjunction. So the length of the pattern, how many bars have formed over the, how many bars make up the pattern. Also the interval, meaning what does each bar represent? Is it 4 hours? Is it 1 hour? Is it half an hour? And then look at the age, like in terms of the freshness of the pattern. Obviously, patterns with zero candle age means it's fresh. It means that we haven't seen any other candle since the pattern was identified. So these would literally represent your very freshest trading opportunities. Now, in addition, what we've also done was add this tab here called expired trading opportunities. The idea here is to show you or to take them out of the equation, literally, when a pattern has gone beyond its sell-by date. So just like you would not keep a pint of milk on the supermarket shelf after a certain while, so a pattern can go stale. As you can see here, this one has got a lot of action afterwards. We never reached our target. It just kind of went along sideways. So a few conditions can cause a pattern to be expired. Firstly, it could be something like this. Secondly, you could also have the pattern reaching its target level, and once that has happened, we say, well, you know what, the result that we expected has actually been achieved, so there's no point in really trading this pattern anymore. And then we move it to the expired trading opportunities. And the third case would be if the price actually turns around and continues in the opposite direction for some significant length. Then we say, hang on, things did not go according to what we expected at all. We actually had a turnaround in price, which means this pattern is now invalid and we expire it. So when you log on initially to this new trading platform, you would notice that your expired trading opportunities tab has 0 patterns. That's because it is a client-side function. In other words, that's your browser will pick up which patterns have expired as you've been using the platform. So everybody starts with 0 expired trading opportunities, and as you keep the application open, so you'll find more and more of these opportunities expiring, and this list literally growing larger. So it literally means that this list for me, in this list of active trading opportunities, I can consider all or most of these still tradable. Now we are still working out some kinks. Also, in the very first time that you log in, you might find some very long-term patterns with some history beyond them, you know, and it's arguable whether a pattern like this should be expired or not. Obviously, these questionable items will only be right at the bottom. Like this one, for example, this is a pattern that has clearly expired. The price expectation was for it to go bullish to a certain target of 56.39, but the price has literally made a full, complete turnaround. You also find sometimes initially when you log on, you'll find some patterns that have actually expired in the active list. they move just a few minutes later. So we'll come back and see if these ones have moved. This is one of the best features I think that Autochartists have seen in a number of years, because it takes a huge burden off the trader, of you guys, to search through these patterns and look for and you know, waste time on looking at patterns that could not be traded anymore. A final quick word on another change we made is the searches. Previously, in the old version, we had a different set of searches for chart patterns, Fibonacci patterns, and key levels. Now we've consolidated them into one single type of search. There's only one list of searches now, and we've brought in the search criteria for all different pattern types in the advanced search section. So when you set up a search, you can literally set it up for chart patterns and Fibonacci patterns and key levels at the same time. All the different criteria that used to be separate is now all consolidated to one single list. I just got word that my connection is lost. Okay, sorry about that. We had a little bit of a connection issue. On the network here. Right, so let's start by taking a look at the difference between complete and emerging patterns. Just waiting for my screen to refresh here. For any chart pattern, there's basically a set of criteria for that screen, for that pattern to be identified as a chart pattern. Now, for most patterns, you will find there are 4 touching points on the support and resistance lines respectively. So the price bounces between support and resistance, and they form 1, 2, 3, 4 touching points, and then it breaks out through the opposite side, depending on whether our initial trend was bullish or bearish. The exit might also be bullish or bearish. So typically 4 points, some of them also have 5 points. When it's a 5-point pattern, you can imagine that the initial trend and the breakout would be in opposite directions, and then we call it a reversal. But in this case, our initial trend was a downward trend before it went up and came back down, up and came back down again. So our initial trends and our breakout are in the same direction. That's why we have here, let me just quickly highlight this for you. That's why we say in this trend change indicator that this pattern is actually a continuation. A nice illustration of this you will find in when you're creating a search under the advanced search section under chart patterns. Here you will see just a little graphical illustration of a continuation pattern where the initial trend and the breakout are in the same direction, whether it's bullish or bearish, or a reversal where you have the pattern actually turning around in an opposite direction. So let me show you the screen here. We've got these are the 16 different pattern types that we identify. You can see, for example, a falling wedge or a rising wedge. These are reversal patterns. So they've got 1, 2, 3, 4, 5 touching points. Whereas with typical continuation patterns like a channel, it only needs 1, 2, 3, 4 touching points before it is expected to break out. So with emerging patterns, our recognition engine detects that these 4 or 5 touching points have been identified. It then looks at the angle of the resistance line and the support line. It then classifies the pattern based on those angles to say it's a channel or a rectangle if the two lines are parallel. Here, for example, here's a channel, Wilmar International. You can see very clearly these two lines are parallel. For rising wedges or falling wedges, the lines slope in the same direction, but they're not perfectly parallel. And obviously for triangles, the resistance line would have a downward slope and the support line would have an upward slope, and so forth. So once all of that criteria has been identified, we say, yes, we have a chart pattern. Except if we strictly follow the charting theory, it would not be regarded as a completed pattern yet. Why? Because and I'm quickly going to switch to emerging patterns here to give you an illustration of that. Because although the price has bounced off between the support and resistance as expected, we don't have the breakout yet. This is the most important visual clue that you will see between emerging and completed patterns. For emerging patterns, we've extended the resistance and the support lines with these two yellow dotted lines. I'll enlarge the image so that you can see more clearly as well. Because what we want to illustrate with these extensions of the support and resistance lines is actually the range in which you are still trading. Now I'll talk a little bit more about the range in a second, especially when it comes to swing traders. Compare this again with completed patterns. I'm just going to keep both types of patterns on this list now so we can just flick between them. Comparing the visual difference between emerging and completed patterns, here you'll see a pattern that is complete. The breakout is very small, but once it's broken out, we see an arrow with a colored arrow that is colored depending on the direction. So the bearish breakout would be a red arrow and a very clear red price level. This is our target level, and this is where we're expecting price to go to. We've got this little gray block as well. It's actually a complete target region. So we're saying the target should go at least to this level, and it could go to anywhere inside this gray block. So that's the important visual discrimination between completed and emerging patterns. Just to show you a different example of a bullish completed pattern. The breakout here was also quite small, but we did have a breakout to resistance, and in this case there's a bullish price expectation. Now on your grid you can quickly pick up the difference between emerging completed patterns. There are two visual cues. The one is this column here that says type. There you can read the difference, emerging or completed. And the other important difference is this little directional arrow. These show you we have a downward arrow indicates that the expected direction is bearish, and when the arrow is gray, that's an indication that the pattern is emerging, and when the arrow is colored in, the pattern is completed. So it's also just another visual distinction you can make. Here we've got quite a long list of grayed out arrows, and you can see it matches the type of pattern. Okay. So now the question is, what do we do with them? Why do we have this distinction between emerging and completed patterns? Well, our thinking initially was we've got this recognition engine, and it is able to pick up a pattern based on the criteria of its turning points and the slopes of its support and resistance lines. So wouldn't it be great to pick up the pattern even before it's broken through the expected support or resistance level? It actually gives the trader a little bit of an earlier look into the potential future, if I could put it that way. So it's an early warning signal. You can say, look, here's a pattern busy forming. If it does continue to break through resistance, in this case, then we'll have a well-formed chart pattern. And if we have a well-formed chart pattern, there's an expectation and a target level for the price to go even further to the target level, depending on the momentum of the price. So first and foremost, our thinking originally with emerging chart patterns is, let's give this to our traders as an early warning system. However, what we've realized subsequently is also that they serve, or the emerging patterns also serve as a very nice tool for swing traders. Traders that aren't necessarily looking for breakouts and a trend to follow, but they look for a certain price range. So they look for lines that are more parallel, where a trend can be spotted, and then the expectation is that the price will continue bouncing between the support and resistance lines until one of those are broken. So in a case like this, for example, you can see this is a head and shoulders pattern that is busy forming, and obviously we know if the price breaks through this support level here, we have a very strong signal for a further downward movement. But before it does, as a swing trader, my expectation is simply that the price will go back down to the resistance level. And that in itself forms a trading opportunity for me. That's one of the reasons why we've also added this results filter section, so that traders who use both types of opportunities can list their trading opportunities together on the same page. Let me just quickly see, I've got a question. Will we have anything on stop loss levels? Thomas, I'm not going to cover much about stop loss levels at this stage. It's pretty much up to you, and it's actually a different topic for a different webinar. But when you look at this view analysis button here, just to quickly digress a little bit, we have a price range forecast, and the forecast tells you that at a particular point in time for a particular instrument, we have different expectations over different time frames. And this sort of view tells me that within 1 hour we expect price to be trading inside this range with a 68% probability, and within 1 day it should be somewhere in this range with a 68% probability. That 68% comes from a simple standard deviation from the mean. It's a statistical measure, and it's taken from data, I think, over the past 6 months. It's not a sure, it's not a very exact science, but at least it gives you a starting point to give you a rough idea of what is a realistic range. Other than that, obviously, the next level of support or resistance would make sense to place a stop loss. If you entered into a bullish trade and you see your next level of resistance slightly higher, you would want to place your stop loss just slightly below that resistance level, where you can be sure the price should go before it reaches the resistance. Okay, so now we make a distinction between two different types of patterns, and I'm going to switch back to our list of the 16 different pattern types. Here you'll see that some patterns have, like the triangles for example, they have support and resistance lines that are converging. So the price will bounce between support and resistance and eventually gets pushed into a corner where it has to break out, out of which it has to break out. Even the falling wedges usually have less of a dramatic conversion between support and resistance, but there will be a point in time when these two lines actually touch in future, and then price will have to do something. It will either go up beyond support or down below resistance. So what we call these patterns are non-trending patterns. In other words, there's no sideways trend that we can look at. Alternatively, we have patterns like the channels. I'm not going to include triple tops in this definition just yet, but we've got channels, rectangles, also sorry, in some cases we do include the triple tops. Basically, what we're looking at with patterns like these is that there's a certain sideways movement expected over the duration of that pattern. So let's just look at a channel up, for example. This bouncing action of the price between support and resistance is expected to continue because these two lines are going in parallel. These type of patterns generally make the best type of swing trading opportunities for emerging patterns. So when you're trading emerging patterns, these are the ones you want to look at. You want to look at your channels, your rectangles, even your triple and double tops and bottoms, because there's a specific range that the price moves in between. Your wedges are generally also, but now it depends with the wedge. Let's just quickly find some wedges here. Here we've got a rising wedge. See, with a wedge, if the resistance and support lines are far apart, then we've got a nice big fat range, and these two lines are not converging very fast either. So this is a great swing trading opportunity. I would definitely take this and say, look how nicely this turnaround is formed on price. I would definitely expect it to have the potential to at least touch this level sometime in future. So Thomas, if you want to know where I would put my stop loss here, I don't really know what a percentage profit would be in this case, but I wouldn't put it right against this line over here. I would go slightly more conservative and place it probably around the 42, 43 price level in this case. It may very well reach support here, and when it does reach support, I would think, hang on, what is it going to do? I would watch it very carefully to see, is it breaking through the line, or is it really like bouncing back off it? And when it bounces, there would be a completely different pattern forming here. If it makes a significant bounce, we would be looking at a bearish rising wedge forming from where this is the first point, that is the second, that is the third, and this is the fourth. So then the expectation changes around, and I say, well, I would like to take this ride back up to the top if it continues to go that way. Okay, so just to summarize, remember the similarities between completed and emerging patterns are that they all have to have the same shape. The touching points have to adhere to the conditions. The slope of the resistance and support lines have to adhere to certain conditions. The only difference is whether at some point in time the price has, after we've met those conditions, whether the price has broken through the support or resistance line, and it obviously have to be in the same direction as our expectation. For example, I'm just clicking around randomly, looking at these different patterns. So in this case, we have an emerging pattern. It's 13 candles old, but look, the price has almost touched the resistance line. If at some point the price continued towards resistance, but it turned around and it broke through support, what would happen to this emerging pattern? We won't remove the emerging pattern, but it would definitely become an expired pattern. So that would definitely be, let's see what we've done here with, it looks like we've expired some emerging patterns, and let's see if we can find the reasons why. This one, well, look in this case. This could be potentially a confusing example. When this pattern was identified, the price was already so close to the support level. It's a bearish pattern. See, notice let me just use my spotlight here. Notice the direction. The direction is downwards. The expectation is bearish. So we're expecting price to go down, and we should break down through support at this point. But notice how close the price already is to support. By the way, to get this enlarged view, you simply click on the price graph and it will open a new window with this large view. See how close the price was to the support level when we identified this pattern. So this directional arrow points to a level that's way up above the current level, but it's actually pointing to some point in future on the support line, which is the normal algorithm for our indication on emerging patterns. So what happened very soon afterwards was that the price went beyond the resistance line and it actually completed. So the emerging pattern has expired, and I'll bet you'll find this very same as a completed pattern under active trading opportunities. It's probably this one, I guess. There it is. You've got that exact same pattern, and now it is simply completed. And after it's broken through, now we've got our target level. So this you'll find happens a lot during the day. Emerging patterns that complete go to the expired section, and emerging patterns where price goes in the opposite to the expected direction will also go to the expired section. Okay, let's look at another expired trading opportunity, expired emerging. Here's a great example where things did not go the way we expected them. This was also recognized very close to the support line. The expectation was bearish, except what happened instead, the price went up and it went up again, and with a huge upswing like this, we're saying the direction and the momentum of price is going completely the wrong way, so let's not consider this a trading opportunity anymore. Notice how you'll find it almost looks like the price moves in rather blocky sections. You can almost draw these imaginary lines across. The reason for this is usually because it makes it, the difference is in either it's in a currency, so it's basically cents or pennies, depending on what kind of stocks you're looking at. So the price can only go up or down in certain units of currency, and when you get these blocky movements, it means these are the units, and it means we have very limited volatility or very limited change in the price action. So this is usually a sign of a pattern that you should look at with great caution. And another thing to look at is the length of the pattern. Like I said to you earlier, this pattern has length 20. That's a very, very short-term pattern. So use it with caution. Let's look at this last one, what happened here to this emerging pattern. Very interesting. For this emerging pattern, price did stay inside the range for quite a long time. And I think what expired this pattern was simply the duration or the passage of time. You can see a lot happened and it stayed inside the range, never really going all the way to touch support and resistance, but I mean, our expectation was for it to go to support. It didn't. So it just, carried on in a very sort of sideways way. And so, after a while, the milk goes off and we say it's expired. Okay. I think I've covered everything I wanted to cover. If you have any questions, you're welcome to put them now. Type the questions in the little provided box, and I will answer them as best I can. In the meantime, something else that I'll show you is the performance statistics. Now, this is also something that we're still working on in terms of the presentation of it. Let me just go back here and show you how I opened that window. Use my little spotlight here. right down at the bottom left here under the download section, there's a link that says performance statistics. Currently that link takes you to a page that looks like this. It's going to change shortly. This page will be replaced with an intermediate page where we have much more information about different breakdowns. It won't be for all the exchanges covered by Kim Ing, for example, because now here we've covered all the symbols in all the different types of markets. You've got NYSE, NASDAQ, Hong Kong, Malaysia, Nikkei, Forex, and indices, and Singapore. There's a lot of stuff put together here. But just to explain to you what this section shows is these two numbers. It's basically the quantity of patterns that we've evaluated and identified. And this is the quantity of patterns that turn out to be correct. Now, this is based on the completed patterns. So patterns that have broken through support or resistance, this is the number of patterns that actually reached the target levels. So it shows you we have roughly a 64% overall average across all markets for this time period from the end of 2010, so it's about a year and 2 months ago. The next thing that's interesting is you can see that different pattern types have different levels of accuracy. We also break it down and show you how many patterns were identified and how many of them were correct. Like ascending triangles in this case is a very high 74%, channel down even more, and like for example with rising wedges and falling wedges, here you see rising wedges being quite significantly lower, only a 59% accuracy, which is still good, mind you, but we consider it low, that's why it's colored in pink. Rising versus falling, you'll find that during certain times in the markets, different pattern types, if the market is predominantly bearish or predominantly bullish, you'll see that these two flip around. The one becomes more successful than the other. So it gives you an idea of what's been happening over the past year. These statistics are also updated once a week, I think, but you don't really see a huge change in them. You only see it very gradually, slight changes in the percentages overall. You can have a look at that, but also expect to see some changes or some updates on the application in the near future. A question came through: as a KE client, am I able to obtain access to Autochartist? I would say yes, but I'm not sure under what conditions, under what terms and conditions. So please contact your KE representative and ask them that question. They'll be able to tell you whether you need to have either a funded account or whether you have to make a small monthly contribution. I could tell you this, that if you get it through them, whatever you have to contribute or pay would be significantly less than if you bought the subscription directly through Autochartist. And that is exactly why we have these partnerships with large brokers, because they have the ability to offer this service to you at a significant discount. Okay, any more questions? If we don't have any more questions, I would invite you to try out this new platform. I think it's much more user-friendly. We've also updated our user manual. It's now an online HTML version of the user manual, so we can bring updates and as we add new features, the explanations can come through here as well. So play around with it, and we always invite you sincerely to contact us if you have any issues. Contact support@autochartist.com. If you have questions about using the platform or anything related to the Autochartist platform, we try to answer your questions within about 24 hours. After which it gets escalated rather quickly, so we try and get to you as quickly as possible. Otherwise, I'll say thanks very much. If you don't have any more questions, thanks, and you're welcome to email us afterwards. And best of luck with your trading. It's late at night. I really appreciate you joining us and giving us your time. All the best. Thank you very much.